Hello, and welcome to today's webinar, a deep dive into public sector asset allocation. My name is Beth Conradson-Cleary. I'm with the City of Milwaukee 457 Plan, the Executive Director. I'm also a member of the PRRL Plan Sponsor Advisory Council. A few quick things before we begin. We are recording this presentation and it will be emailed along with a copy of the slides to all registrants tomorrow. You will be muted for the duration of the webinar, but please submit questions throughout the presentation in the Q&A box found in the menu at the bottom of your screen. Your questions will only be visible to the speakers, so please feel free to send those anytime, and we will get to as many of them as possible at the end of this presentation. We also have the chat feature open, which you may use to chat with your fellow attendees during the presentation, sort of like modern day virtual passing notes. Joining me today in this presentation, Greg Jenkins, Head of Institutional Defined Contribution, Managing Director at Invesco, Vince Ortega, Vice President, Relationship Manager at Capital Group, American Funds, and Jack Vanderhei, Research Director at the Employee Benefit Research Institute, otherwise known as EBRI. Welcome and thank you for being here. Before we start walking through the slides and doing this presentation, I just wanted to say that this is a very exciting webinar that the panel and I are really, we've spent some time thinking about the slides, quite a bit of time, and how to have this conversation with you. But what we're probably most excited about is the fact that this is the kickoff conversation to be talking about different aspects that we're able to glean and learn from with this new PRRL database. And we were just talking before we started here. I just checked with Jack to find out how long EBRI's been working with the private sector plans to start taking a cumulative look at all of their data. And it's been roughly 25 years. This is the first time that our universe, public plans, has been able to get our arms around this collective data set, which is pretty remarkable because once you have the information at your fingertips, then you can start to look at, slice, dice, understand, and analyze what that means for our population and who we work with. So as you hear this conversation, I want you to think about it through the lens of your own plan, which we tend to do already, but really think about your demographics and the questions that you may have about the information that you're learning, and think of this as a springboard for future conversations. If there's different areas that you think that would be helpful to look at, we can always have that conversation, and you can bring those questions to the Executive Director at NAGDA, Matt. He can help coordinate and facilitate that, especially with the Advisory Council. And with that, I will hand it over to Jack to kick us off with reviewing the first couple slides.
Thank you, Beth. Before we get going, I just want to mention to everyone that, as Beth pointed out, this is the first year of data acquisition for the PRRL project. What we're going to be looking at today is end of year 2019 data, but we're already in the process of collecting end of year 2020 data, and hopefully that's something we're going to have available certainly by third quarter for one of the NAGDA conferences. Overall, we have data on about 2.3 million individuals, and we have total assets of approximately $113 billion that we're going to be analyzing for you today. We could go to the next slide, please. I just wanted to show you the granularity of the types of asset allocation we're collecting. If you want to do a quick count, there's 25 different categories that we're collecting. Obviously, some of them are relatively small and don't really even show up on this particular graph. But when we do some of the other types of analysis in the publication that will be coming out in a couple of weeks, we'll do much more conditional analysis, so conditional upon a particular asset allocation being available in a plan's portfolio. So some of these will show up in much more striking detail. The one thing I just wanted to point out, I have numbers here both on dollar weighted as well as participant weighted bases. So if you take a look at the dollar weighted, Obviously, the one that's most striking is the large cap domestic equity. Overall, about a third of the public assets, public DC assets are in that particular category. But if you look instead at the blue participant weighted allocations, you see much more of a shift towards the target date funds on the right side of the axes. In fact, large cap domestic drops to only about 1/6 as opposed to 1/3 if you're looking at a participant weighted basis. And you see stable value, target date custom, as well as target date off the shelf, all having between 15 and 20%. The reason you get that disparity between the participant weighted and the dollar weighted, obviously, is that so many of the participants on the target date funds are relatively young and therefore have relatively low overall account balances. So you would expect, if these trends hold up over time, that even on an asset weighted basis, you're going to get much more growth on the target date side. If we could go to the next slide, please. We here break this down by overall age groups. We have 20s, 30s, 40s, 50s, and 60s. Publication we're going to have coming out in a couple of weeks. We'll have it on a 5-year age cohort basis, so you're going to get a little more detail, and we'll also go into people in retirement. But the thing that really sticks out, obviously, is on an asset weighted basis, the target date funds definitely dominate for the young participants. We're seeing that for people in their 20s, nearly 2/3, 63% of the total assets that we're looking at are in the target date funds. That's either the off the shelf or the custom. We also see that money and stable value, as we're going to be looking at the next slide in a comparison, really start to increase quite rapidly for people as they approach retirement age in the public sector. So if we could just go to the next slide then quickly. What I'm trying to do, and Beth kind of alluded to this, I've been working with the Investment Company Institute since the mid-90s on doing a similar type of database for corporate 401k plans. And we have all the information on all the different asset categories for that also, but I just wanted to do 2 quick comparisons. And if you look at the left-hand side, you see the money and stable value that we just looked at for the PRRRL database, as well as the money and stable value next to it for the corporate 401k database. And as you can see, the people approaching retirement age are much more reliant on the money and stable value in the public universe, getting all the way up to 29%, than they are in the corporate side, getting only up to 14.2% by the time they get in the 60s. The other thing to note is that the target date funds are much more prevalent in terms of asset weights for the young individuals on the public side, as we said, 63%, but goes down to only about 12.8% for those in their 60s, whereas the comparison next to it on the target date, you have about half of the money for the 20-year-olds is in target date, dropping down to about 18.4%. So with that, I'll turn it back to Beth and get some discussion regarding these topics.
Thanks, Jack. I have a question for Vince. In your experience, what are the trends that you're seeing in the investment menus?
Thanks, Beth, and thanks to everyone else joining us on today's call, and of course Jack for all the charts here. I know there's a lot of work and a lot of data, so really appreciate being the guide light here for today's conversation. And, as Jack noted, within the overall distribution of assets, in particular the chart on page 3, what you see there is many plan offer a high number of investment options to participants. And I think within that framework, we note that many of those options have very low utilization rates. We saw, as Jack mentioned, higher allocations to U.S. equities, target date funds, stable value, and with the latter most likely attributable to them being default options, while we see very little utilization on other options such as emerging markets, REITs, small caps, and some of these other specialty funds. And as a result, I think it's fair to say that a number of participants, they may be overwhelmed and therefore oftentimes not probably making investment decisions that are in their best long-term interest. So it's within this context that we had made some observations that participants may be investing in too many options, oftentimes investing in multiple vintages of target date funds, or the alternative, investing in one single option. This low equity exposure with younger participants really shows up on some of these slides. And then on the opposite side of the spectrum, having higher allocation to equities as participants near retirement, potentially exposing themselves to more market risk. So Beth, I think that the trend that we see today is similar to what we've probably seen in the corporate space, which is the need to simplify the experience, making it easier for participants to make better decisions to improve their outcomes. And some of these ways, and it's in progress right now, but consolidating the use of multiple record keepers to one single provider, using this consolidation effort to review the fund menu, paring down the menus to a more manageable number, say 20, 25 options that include a target date suite, and ensuring that participants really just have access to the right set of investment options. Again, all in an effort to simplify the experience and just making it easier for participants to make better decisions. So thanks for the question, Beth.
Okay. All right, and then I have a question for you, Greg. As you experience working with both the corporate and the public side of plans, what are the key differences and similarities for investment diversification?
Thanks, Beth, and it's great to be on the program today. Thanks everyone for joining. And I'd like to also echo Vince's comments. The amount of work that it took to get this data pulled together is hard to describe. And it boils down into the world's largest three-dimensional spreadsheet that Jack has to work with every day. So we appreciate all of his hard work as well. I'd like to go to slide 5. And first, when we're comparing public plans and corporate plans and participant allocations, I'd like to first just kind of focus on target dates for a minute. And first, I'll share some good news. The good news is when you look at the younger age groups and the percentage in target date funds, it's impressive. 63% for that youngest group in their 20s, 41% in their 30s. Those are good numbers, especially considering the auto enrollment challenges that many of you all have. So that's encouraging. Now, the not so good news is when you look at the allocation overall, and keep in mind, when you look at these age groups, that really the vast majority of the assets are in those later age tiers. That's really where the assets are. And that's also where you would argue that a target date fund is most important when someone's on the later stages on their road to retirement, when it's critical that they have a diversified portfolio. And you can see those numbers really start to drop off. And when you look at, I'm going to read you a number that's not on the slide, the overall allocation to target date funds for the public plans was 15%. For corporate plans, for this data set on the far right, it's 21.3%. There's still, I think for both corporate and public plans, there's still a long way to go. There's still a huge amount of assets that are not in professionally managed diversified options. And so, the same problem remains. There's plenty of research showing that participants are not well equipped to make their own portfolio decisions. I think we're going to see more and more evidence of that on the program today. And there's work to do in this industry to try to correct that. And we'll get more into those details in just a few minutes, I think.
Definitely. And I also wanted to acknowledge we're seeing the Q&A come through, the questions, and thank you so much for that. We are going to get to those questions throughout or at the end of the presentation. And if it makes sense, we'll incorporate it here. I know there's a lot of questions too about understanding the plan type and if it's broken out. We have looked at that, and then some you'll see it touched on later on, but that's a whole nother topic. It could be looked at for a whole nother presentation if you really do a deep dive into that aspect of it. And then there's another point that someone made, which we've had a discussion on as well, and that is those plans out there, the DC plans that also have complementary DB plans available for their participants, and how that's going to play into what we're seeing in terms of the asset allocation and what type of risk that our participants should and would be able to take, given that they also have the safety net of a DB plan at their available to them as well. So, it's great. Everybody's thinking about these questions already, which is wonderful. And these are the types of nuances that we've been having discussions on too. So keep the questions coming and we'll get to those specifically at the end. Jack, do you want to move on to the role of the structures and the defaults?
Okay, thank you. As was mentioned, there are many breakouts that are going to be in the publication, the PRRL publication coming out in a week or two that we didn't have time to cover today. Things like the impact of whether there's a defined benefit available for the individuals, different types of default investments, and the impact of automatic enrollment. Those are all going to be covered. What I want to do, though, in just the next 2 slides very quickly is if I could move to slide 7, please. Just spend a couple minutes setting this up. Since there are 25 different asset classes, obviously the thing that we have to try to focus on, as Greg and Vince mentioned, is basically are individuals having sufficiently aggressive portfolios, especially when they're young. So I've come up with something that's basically being referred to here as the total equity proportion. So basically think of it as any fund that's 100% equity goes in the 100% category. Target date funds, I'll do the age appropriate equity concentration that we have as far as industry averages. Things like balanced funds, I'll weight 60% towards equity. And then I'll do an overall weighted average across all 25 asset categories and then break it out by age. What you're looking at here is just a real simple bifurcation as far as whether an individual has at least some of their investments in a target date fund, that's the blue line, versus absolutely no investments whatsoever in the TDF. It's not exactly the same as whether or not there was a TDF in the investment menu for them to choose from. Sometimes for the smaller plans, I just simply don't have a sample size big enough to put that portfolio together. So this is a quick way of showing if the participant actually does avail themselves of having a TDF, what happens as far as the overall equity proportion. And as you can see, it's quite striking among the young individuals, and think of the red line as the totally participant directed individuals, how small their overall equity allocations are. In fact, less than 20% for people between 20 to 24. Whereas the blue lines are obviously going to look very much like the glide paths that people are quite familiar with. Starts out very high, nearly 90%, and starts to work its way down. By the time you're in the 65 to 69 range, you're probably a little bit less than 50%. And you note that the 2 lines start coming closer and closer together at that point. But basically, if you're in a planning environment, which you're assuming you're going to have some positive equity premium, and you want to make sure that the young individuals, the ones who are going to have the most time to invest their money, are going to be able to benefit from a appropriate equity concentration. Certainly you see the amazing role that the target date funds play in getting the young individuals up to where many people think they should be. And then on slide 8, one of the questions that were coming in is, can we split this out between supplemental plans and primary plans? And I'm sure there'll be a lot of discussion about whether or not the results we're seeing here necessarily are what people thought should be the case. But what we're finding is that in the primary plans, we have something that looked very, very much like the TDF glide paths we just looked at. Whereas the supplemental plans, we find that you have much, much lower equity concentrations for the young participants than you do in the primary plans. And what that means as far as if you already had another plan, defined benefit, for example, whether or not that's the appropriate risk posture is something that we can discuss going forward. So Beth, I'll turn it back to you.
All right. So question for Greg here. Given your experience, how should plan sponsors think about risk tolerance relative to different plan structures?
Thanks, Beth. To answer that question, I want to start by pointing out something Jack showed on slide 7, if we could go back to that. And one thing that we know from plenty of research is that participants that aren't in target date funds don't tend to put together the best portfolios on their own. For example, young people in stable value. An older participant might have 100 logical reasons why they're in stable value, but a younger participant, it's hard for us to conjure up a scenario where that makes sense. If you go back to 8, I call this the hockey stick chart. We really shouldn't be seeing any hockey sticks on any of these charts when it comes to allocation. So I think this is an indication of a trouble spot. If your participants are covered by a defined benefit plan, then they can afford to take more risk in their DC plan. They should own more equity because of the portfolio bedrock that the defined benefit provides in their overall portfolio. Think of it like owning a bond. If you have a large allocation to a bond, then you should put money into equities to offset that, especially if you're younger. And you can see this if you look at custom target date funds for the larger sponsors in the public space that have custom target date funds. Many of them have higher equity allocations because that's what makes sense when your participants are also covered by a defined benefit plan. And this can be a little counterintuitive for many participants. And I think we're seeing this here. Many younger participants in plans that are deemed supplemental, even well into their 40s, are invested far more conservatively than there should be. So there are a couple of remedies we can talk about a little bit later in the program.
Thanks, Greg. And Vince, and I actually have something to add to what you just put out there, Greg, and I'll save that for a moment. But before we get to that, Vince, I have a question for you. Given the research that you've done at Capital Group regarding retirement security for public plan participants, what are the trends that you're seeing?
Thanks, Beth. And this hits on a piece that American Funds has recently published related to DB and DC plans working as complements to each other. And even though DB plans remain relevant and continue to play a significant role in retirement security within the government sector, changes to benefits, eligibility requirements, or shifting from DB to DC plans as your primary source of retirement, I believe this had led plan sponsors to think about the role of deferred compensation plans, much differently today and going forward. We're seeing a heightened level of awareness that DC plans are not just the supplemental or savings plans that have historically been perceived. We're now recognizing the need to view them as a critical component to, closing that security gap, especially for the younger workers. And as a result, we're seeing opportunities here to help drive better outcomes and think of ways, and similar to what Greg said, viewing DB plans differently, as a secured source of retirement income, or taking a bit more risk with your DC plan, understanding how DB funds can impact investment success, driving that equity exposure across the participants' investment horizon, particularly with the younger generation. And I think there's also here an opportunity to rethink about the role of fixed income, or promoting higher international or global equity options as a diversifier. And then lastly, understanding the benefits of active management. So Beth, those are just a few things that we're seeing in the marketplace today.
Thanks, Vince. So to piggyback off of what Greg was saying earlier, I just want to share from a plan perspective, something that we took a look at a few years ago with the city of Milwaukee. We actually did some benchmarking to take a good close look at, and we broke it up based off of the age allocations as well. We wanted to see how are our participants investing their funds. And when we did that, we saw there was a disproportionate amount of younger participants who were saving, who are invested in stable value. That was a big impetus for us to take a good hard look at what we were offering. And also we were trying to streamline, to the points made earlier about having too many choices. And if you think about deferred comp, it's just one of a ton of benefits that our participants have at their fingertips. So not only are they navigating our one benefit, to have so many options within that one benefit can be really confusing. So when we were looking at that and we did that benchmarking and that snapshot to find out what does this look like for our plan participants, that led us to go towards the target date route. And at the same time, we also were fortunate enough to implement the auto enrollment. What we saw was a huge shift. And one thing I'll also note is that when we look at the younger participants and how they tend to gravitate towards target date funds, something that I was thinking about and wondering is, could that be because they're a product that's been introduced relatively recently compared to some of our older participants that never got into target date funds simply because they weren't around. So that's something else to think about as we look at this landscape and what it actually is telling us. So speaking of kind of the differences between our participants, next we're going to shift to slides where Jack will walk us through about the role of demographics when it comes to looking at this information. These are some of my favorite slides actually, because they look at things such as gender, age, tenure, and age, specifically those categories. Jack?
Thank you, Beth. So before we get started, I'm going to focus primarily for time purposes on gender and age. Again, in the publication that's coming out in a week or two, we will be looking at other demographics. We'll be looking at salary. We'll be looking at tenure. One of the things I just want to mention is that for me, this is really exciting because as was mentioned, I've been doing the corporate 401k research now for 25 years, and I've never been able to pull in gender information on any of that research. So this is something brand new that we're going to be looking at in just a couple of minutes. If we could go to slide 10. When you want to do the gender breakout as far as the overall equity concentration for public plans, at first I did this just simply based on age and the gender designation, and it really didn't tell a very clear story. So what I did was go back and do that same kind of some TDF versus no TDF bifurcation that I had a couple slides ago. And if you look at that top line, that's actually two lines. It's the females with some TDF and the males with some TDF. And probably not surprising, it's going to follow the same glide path profile that we've seen before. And since they don't differentiate based on gender, you really wouldn't expect to see much difference between the two. Where you do see the difference, though, is in the bottom two lines. And if you look at the females with no TDFs and compare them to the males with no TDFs, the red and the blue line, in essence, you find that females have a tendency when you control for age, you control for the lack of TDFs, to have a slightly lower equity concentration than the males. Now, to try to dig into what's driving that, if we could look at slide 11 for a second, it takes a little bit of explanation. If you go back to where we started, where we had 25 different asset categories, what I've done is to do a breakout for each 5-year age cohort, look at the gender differentials, and then basically try to put them in ascending order where a positive number denotes that females have a higher allocation than males in that same age cohort for that particular investment category. So if you want to go all the way to the right-hand side, the two asset categories that are most likely to be chosen by females vis-a-vis males, and it doesn't necessarily apply to all ages, are the short-term fixed income, which is very, very large, more than 15 percentage points higher for the very youngest cohort for females and males, and also the stable valued fixed account, which kind of jumps around, but overall it gives a much larger non-equity allocation to the females than for the males. These are, again, the individuals with no TDFs whatsoever. So if you go over to the left-hand side, you see the largest negative numbers, which means males have a much higher allocation than similarly aged females. And the two that they're most likely to have invested in a larger percentage than females are the large cap domestic equities and the broad international equity. In fact, for the very youngest males, you almost have a 10 percentage point higher allocation for broad international equities for males than you do females. So again, this is the graph showing just the individuals that had no TDFs whatsoever in their portfolio, whether they had that available to them or not, it didn't matter. This was TDF free. There's a whole bunch of very, very small differentials for some of the other asset classes, which are not shown. I basically just eliminated the de minimis differentials. Otherwise, it would have been far too difficult to read what was going on for any of these categories. So again, remembering, this is the people who have chosen either not to have TDFs or didn't have TDFs available to them. If you go to slide 12, however, same kind of breakouts, but now we're looking at individuals with at least some TDFs. And you're probably going to have your attention go to the right-hand side immediately. And you see for these individuals, the females are much, much more likely on an age-adjusted basis to go into target date funds, whether it's the custom or off the shelf, it doesn't matter. They're much more likely to choose them than males in a similar situation. Where do the males go? Again, go over to the left-hand side if you want to see where that's coming from. And by and large, any male who has at least some TDF in their allocation, they're going to be much more likely to also have an investment in the large cap domestic equity and also some mid cap domestic equity. So with that, I'll turn it back to Beth.
Thanks, Jack. And we're seeing all your questions. There's about 10 of them right now, so we see them. We'll get to them as soon as we can. Thank you for your patience. Question for Greg. Invesco just released some research that revealed some differences around views on risk, investment selection, and gender. Are these findings consistent with what we're seeing here?
Thanks, Beth. Yes, they are. Our 2021 DC language study, just getting released this week, covered both corporate and government plan participants. And it shows that women are, in fact, more mindful of risk. They're more skeptical. They ask more questions. and we saw this in focus groups as well as in our survey. When allocating their own portfolio, we found they're much less likely to select riskier investments such as standalone equity funds. They do tend to select the diversified, professionally managed options more often than men. Now, interestingly, women seemed more skeptical of the risk within target date funds as well. We also did some testing of three-tiered menus where you have target date funds, target risk funds, and then standalone single asset class funds. And surprisingly, women were less likely to pick target date funds and more likely to pick target risk funds than men. It was a small difference, but I think it was meaningful given that the conventional wisdom and what I thought we would see is that women would favor target date funds over target risk funds. But in general, women just think more about risk, and I think in a healthy way. But we need to help, I think, educate to help guide them to put that skepticism in their favor, and again, hopefully keep younger folks from investing in stable value and things that don't make sense for the long haul.
Thanks, Greg. And a question for you, Vince. Vince, is what insights could you share regarding your work on generational trends and the role of occupations?
Thank you. In addition to Greg's comments on gender, I really think this is where we see that generations in the workforce, have a different perspective in terms of investments, the value of benefits, risk, and expectations on how employers will help them achieve retirement security. And when you think back to the chart on slide 11 with participants without target date funds, some very interesting behaviors between female and male participants for sure. But I think that this is where we find that target date funds can play a significant role, allowing for a more appropriate allocation of equities and fixed income across the glide path. Again, pointing to the demographic slides that Jack shared earlier, the data suggests, for example, younger employees that don't invest in target date funds simply are investing too conservatively and not taking advantage of the opportunity to build that wealth during the accumulation phase. Well, those that do invest in target date funds are simply better positioned for success. Again, I think this just highlights how target date funds can help participants in terms of asset allocation. And one of the other areas that we think about, and we want to be able to gain a better understanding, is that of the different occupational roles. And in particular, the cohort that we think about that is unique to the public fund space is the safety worker. And here you have, unique benefit structures where formulas and benefits peak at an earlier retirement age than non-safety workers. Definitely a difference there. You think about the increased longevity post-retirement and this need for higher contribution rates and allocations to equity. And then lastly, understanding the importance of diversification and risk in order to complement the generous DB benefits that safety workers enjoy. So, it's interesting. Our team is in the process of doing more research on safety workers, so more to come there, Beth.
All very interesting things to think about there. And I would also say, too, that another component to think about when you have this conversation about the age, and we're talking about being appropriately invested for the long haul. But one thing we haven't even talked about, but I think it's interesting, too, we know that public servants tend to stay in their career longer than on the private sector. But that's something you have to consider, too. What is the duration of that career when they're in that plan? Are they keeping that money in the plan, or are they leaving? What are the things that can be done to have that exit conversation to educate your participants so that they know they can keep everything put as opposed to roll it over and sometimes have adverse tax consequences? And questions, too, is thinking about your plan and say, to what extent do we get in front of our participants to take a good look at what their asset allocation is? Is it just when they're beginning their career and when they're about to retire? Or do we talk to them along the way And if we are, that's great, because then they can keep a pulse on where their asset allocation is and that it's appropriately spread out through time. If not, are we doing a disservice by not giving them that option of a target date fund so that they can do the set it and forget it and appropriately tailor it to where their runway is with investment time? These are all different questions to think about too. And then the other thing too is each plan has a different composition. I know in our plan, we have more men than we do women. And when we break down the women and the type of occupations that they have, what does it look like with your medium age of your woman participant? What does she look like versus what does he look like? And how are they potentially exposed to, the question about financial literacy and having an appreciation and understanding of where to put that money? And the public sector spectrum of our participants, you think about, we have everybody from garbage collectors to PhD scientists and everybody in between. And so trying to understand and to meet that need across the broad spectrum of that participant base, these are all kind of things that kind of percolate in my mind when I think about this type of conversation. And, really trying to understand too, everybody who does this work that I've met, it's a very mission-driven type of work. And we're here to help people readily prepare for retirement and do it in a successful way. So this type of conversation, it just makes me excited because we can really start to look at these different features. And I will say too, that having conversations with Matt Peterson from NAGDA, that the question about gender in particular, as it relates to investments, this is something that there's going to be a working group taking a closer look at. And that's the beauty of having the partnership with EBRI and NAGDA, is that we can continue to have these conversations. And, we don't have to just produce a white paper and call it a day, but we can really do a deep dive and try to just look at all the dimensions that are connected to these types of different topics. So that being said, there's also a lot of potential for future research opportunities too. So again, if you have ideas, you can always bring it to Matt or someone on the Plan Council, Advisory Council. We can start doing that. And then luckily, because we have Jack, and he's incredible to work with, because you tell him, okay, this is something we want to know about. Well, what about this? What about that? Well, Jack has he's at the motherboard control panel, and he's able to manipulate and understand those very specific types of questions. So I know that some of those questions, speaking of, we have a bunch in the Q&A chat, so thank you for throwing those out there. And I know the other panelists have access to it as well. So if any of you see a question that you want to respond to, please jump in and feel free to take it. If not, I can try to dole it out here. I know there's a specific question, and I believe, Jack, you're probably going to be most appropriate with answering this, but it's a question about how many plans have auto enrollment, and of those, what funds are the QDIA?
I don't have the exact number. We have 189 different plans and 4,400 different subplans in the database. So I can certainly look that up. That is something that we're planning to put, though, in the publication coming up in a couple of weeks. The different types of default investments show pretty much what you would think. If a TDF is used, obviously you're going to see things very similar to the glide path type age curves we saw a couple minutes ago. Stable value defaults have driven, especially among the young individuals and those with very low tenure, very, very high non-equity allocations. But again, I'll have the actual numbers in the publication for you.
Great. And I think there's another question here too that will probably have a similar answer. Let's wait for the publication. The question is, and we've kind of touched on this already, but have you broken this data out by type of plan, primary DC versus supplemental DC? And if yes, are the asset allocations different among the two?
Right. You saw one chart very quickly on the total equity proportion on primary versus supplemental already. We also have everything broken down by different plan types, and we can obviously do second, third level type breakouts for you on that. Right now, it's getting to the point though that there's so many permutations that we're not going to be able to fit everything into the publication per se. I've already got Matt, I think, to agree to an online appendix where I'm probably going to have over 100 different charts available there. The one thing I would say though is if somebody has a pressing desire to see something that does not get put into either the online appendix or the publication per se, just feel free to send me an email, vanderheide@eber.org, because that's something we can certainly work into a follow-up publication.
Great. And then
Beth,
here's an interesting
as long as
question.
I've got the microphone, I'm sorry. I'm sorry.
Go for it.
Just one quick thing. I saw an ESG question pop up while I was talking earlier. The one thing I did not mention is, in addition to the 25 asset allocation categories, which are obviously mutually exclusive, we also have a series of 9 different fund flags that we're collecting for each of the investments. So we're going to have information on active, passive, hybrid, mutual fund, commingled fund, multiple vehicle types, white label, multi-manager fund, and ESGs. So all of those are going to be subject to a separate analysis.
Okay, great. We've got a question here that I think would be good for either Vince or Greg. I'm not sure if Greg is still with us right now, but any theories on how those with no target date funds? Okay, hi, Greg. So I'll let you and Vince duke out who's going to answer this one, but any theories on how those with no target date funds do acquire a higher equity position?
I can start, and Vince can certainly add on. That's a great question. What do you do about people that aren't in target date funds, and how do you fix their allocations? We've done a lot of research on this. We find that there is a significant portion of participants that just aren't going to go into a target date fund for whatever reason. They are also likely to not be able to, they're not equipped to put together their own portfolio and manage that ongoing, and especially rebalancing and managing ongoing. This is very difficult for an individual to do, even someone that has some skills in the area. So one remedy is to introduce target risk funds alongside target date funds. So not as a default, but as an additional path to professional management. And we've tested this with audiences. We've also looked at the Australian superannuation plans. The larger ones very typically have target date, target risk, and single asset class options. When we tested this with audiences, we find about a third go into target date funds, about a third go into target risk, and about a third go into single asset class options. But overall, you'd end up with more participants in professionally managed options with allocations that make more sense. And Vince, I'll let you go ahead and add on to that. I'm sure you have something to add.
Yep, I would just add a few things there. I mean, as you think about that, education comes to mind. Better educating participants. I think I find that oftentimes, even with talking with folks that I know, they just don't know the differences between equity, fixed, international, U.S. So I think education is critical. I would also say, going back to design, fewer menu options, not giving them this full swath of options where many of them aren't going to be utilized, and being able to be a little more focused on options that are going to be best support their investment objective. And then I agree with Greg's comments about risk-based funds, creating things that, these names seem to probably resonate a bit more with participants where you're thinking about conservative, moderate, or an aggressive allocation? Those would be my comments.
We had a couple of those risk allocation funds available, and there was a lot of questions of like, but what does it mean? You know, like what's under the hood? It's kind of a little esoteric at times. So a question here is, and I'm not sure if anybody has an answer for it, but it's an interesting question. Is there any relationship between representation of women as fund managers in these funds and women's allocations to them? I don't believe we've had any of that information come to the PRRL database, specifically collecting who represents the fund managers. But it's an interesting question for sure. And also, this is a question for Jack. Is there any controlling of women's choices to account for an income gap?
Yeah, I have done some regression analysis based on that. It gets a little bit tricky given some of the problems collecting salary from some of the plans to do just a straightforward graphical analysis without introducing a fair degree of bias. But we do have some information on that, and that probably will be part of that working group, Beth, that you had mentioned a couple of minutes ago.
Okay, thank you. And here's another question. So is there another explanation for why the supplemental investors have lower allocations than primary? For example, is it possible that they are less risk tolerant? And since they are less reliant on the DC savings for income replacement than the primary, are they thinking about what is sufficient, minimizing risk?
I can take a crack at that one. I don't know if anybody can fully explain why this is happening. I think there's a lot of different factors at play, potentially. We do know this in our recent study that I just mentioned. We found that even though the vast majority were covered by defined benefit plans, 61% of our government workers said that they viewed the DC plan as critical to their retirement. So we know people think it's important, even if it's deemed a supplemental plan. One theory I have is sort of this house money theory, and that is, if you're playing with house money, some might decide to be more aggressive with that, but others might say, you know what, I'm just gonna put that away into something safe, and I won't have to worry about it, and I'll have that extra defined contribution money down the road. But that's really, it's just a hunch. I don't have any evidence behind that, and I think, as I said, I think it's an interesting and a complicated question. But I think education has got to be part of the answer here. I think that we can't give up on education. It's a lot easier to talk about than it is to execute. I'm very aware of that. But I think we need to continue to help people understand. And one thing we find is that diversification it's a very powerful word. People believe in it, but there's a lot of confusion around it. And people don't understand that a target date fund is diversified. We've had a lot of interesting responses from people on that question. And I think having a diversified portfolio and how important that is really needs to be conveyed to participants to help them understand that.
And I think also in terms of the education, something that we talk a lot about with our plan and also our educational outreach is having conversations with participants about the target date funds. They're set for the age 65 in terms of when you're going to draw down from those assets. But when we have face-to-face conversations, or in this day and age virtual, with our participants, we try to help them understand, especially if they have additional retirement assets available to them, to really think about it in terms of, when do you think you're going to be accessing this account? And if it's not till you're 70 or your RMD years, think about pushing it back, going into different target date funds. Don't just settle for that age 65 if that doesn't make sense for you. The other thing that we talk about in terms of like that house money concept too, but I think this is more of a prevalent conversation that public participants are realizing, and that is the cost of retiree health insurance. And depending on, and this was talked about earlier, at what age are we seeing our participants retire? Is there a gap between, when they leave service and when they turn 65? And if so, what are they doing for retiree health insurance? A lot of times people look at their DC plan once they understand that larger picture and that that's the number one expense in retirement. Then they start to realize the importance of what this DC plan can do for them, and how that can work in terms of the opportunity to have additional funds available for that big component of retirement, and also the timing of when they need their money to be working and how long for, to grow that investment. So I think these are really unique types of conversations that we can have as public plan participants and sponsors, and kind of contextualizing within this broader context, starting with looking at how are they investing in the first place, I think is a really great place to start. So, and in terms of the panelists, if you see any other questions, I believe we've gotten through almost all of them in some way, shape, or form. But if there's any other questions that you think that are still out there, we can definitely try to answer them. Or if anybody has some additional questions, please feel free to add them to the chat. And if there isn't any additional answers to what have been already previously asked, I guess the question for any of our panelists, is there anything that you'd like to leave us with before we wrap things up for the webinar today?
Hey, Beth, I was just thinking about that last question, and I think there's one thing also that I just wanted to add. As you think about it historically as the deferred compensation plans, as supplemental plans, I think one of the reasons could be this this notion of the historical defaults and the fact that participants, once a decision's been made, whether it's voluntary or involuntary, they don't make a lot of changes once they're in a particular option. So that may have something to do with it as well.
The law of inertia, yes.
Yeah, Beth, I'd like to touch on something you mentioned earlier that I think is really important. We've talked about this aggregate data here, and it's so exciting to have public DC plan data for the first time to look at. But hopefully it'll inspire plan sponsors to look at their own plans, as you suggested, and really dig into the data that they're seeing within their own plans. Work with your record keeper. There's typically a lot of data sets that you can get if you just ask, and try to identify where those trouble spots might be with your allocations. One question we were talking about before the webcast was, people staying in target date funds. Are they doing that? There's some evidence on the corporate side that some participants are getting out of target date funds over a long period of time. It'll be interesting to see if I know there's going to be some more studies coming out on that, but it'll be interesting to see if that's a pattern that appears on the public plan side as well. But I think that's just one of many interesting things that you might uncover in your own plan data, and then you can develop an attack plan about what sort of education, what sort of steps can we take to try to rectify some of these issues. And I'm sure consultants and many others in the industry and record keepers can help plan sponsors come up with solutions for those potential challenges they run into.
Yep. And Greg, let me just add, thinking about 2021, I think, again, we now have the opportunity to use real 2020 data to stress test plans, taking a better look at understanding the scenarios and challenges that played out, and look for ways to improve on those areas that we can control. When you're thinking about, understanding the levers that we can use to maximize retirement security for participants, understanding, the plan design and addressing undesirable participant behavior. And one other thing that, I think about often too is, getting participants more invested appropriately. And maybe that's not in the form of plan design. Maybe it's through the investment of re-enrollment program. So I think those are just a few things that I wanted to add before I think we're here at time. So again, I just want to thank everybody for all your time and listening to our comments.
Yes, thank you. And you are right. We are right against the mark here with our wrapping things up here. So unfortunately, that is all the time we have for today. And a couple quick reminders. If you're a plan sponsor and you want to sign up for the PRRL database, you still can. You can always reach out to Matt and let him know your interest. And if you are a company interested in working with the PRRL, please contact Matt Peterson as well from NAGDA. His email is in the chat, and it has just been, oh, and so is the link to participate in the PRRL database. So with that, thank you for attending today's webinar and have a wonderful rest of your week.